Hey, it's Soleil, and this is episode 116 of the Orange Pill Investor. It is Sunday frickin' night at 10:27, and I I told myself that I'm gonna make 350 videos in 365 days this year. So I'm kind of mailing it in tonight. I gotta do a video, so I'm doing a fucking video. I'm still gonna try to give you some good information. Why do I even am I showing my email? Okay, so I send myself little ideas of shit I want to talk about. So I'm going to talk about. I didn't even mean to show this, but if I'm just walking the dogs and I have an idea, I just email it to myself so I don't forget. And so today I'm going to talk about delta weight. I kind of tried to find a search for that, and I don't even know if it's a real thing, but you know, it's something that I check. And I don't really do a lot of like technical analysis. I've already investigated the assets that I like. So I like Bitcoin, I like MicroStrategy, I like Tesla. And because I like Bitcoin, I like the mining stocks as well. And there could be a ton of shitload of opportunities in the stock market, but I'm not aware of them. And I I'll parrot Sailor when he says there's no second best a lot of times. So I'm really just not looking to diversify. I will listen, and if somebody's interested, I'll take a look at something. Like folks wanted to look at SQ and coin before earnings. I love looking at stuff, but for my own personal investing, I don't really bother with fundamentals and all kinds of stuff. But one of the things that I have kind of looked for is, and this is really going to be a lot, probably advice maybe for option buyers. I'm an option seller, so why would you even give a shit what I think about buying options? And that's because when I'm selling options, I'm selling the ones that are good to sell. And so you don't want to be buying those ones, those options most likely. Not financial advice, but for example, let's just take a look at Mara. Mara's pretty liquid. So I'm going to sell options no greater than 45 days. I mean, if you're setting up options today and you go to 47, that's, I'm not being anal about this. But I'm not going to go to 6 months. I'm not even going to go to 60 days most likely, unless I really had to avoid a margin call or something, and I just needed to get squeeze a couple little extra pennies of frickin' premium out. But generally, I actually go to 5 days out, and you can see I sold the 19.5 and the 20, and the reason is because I can get almost 50 cents at 19.5, right? But going out 2 weeks, you can't get $1. So it's not going to go up to 96 cents. It only went up to 87 cents. And going to 3 weeks, this went up from, was it 48? So was that 40? Yeah, basically it went up 40 cents. So going out another week from 87 to 118 is another 30 cents. So I want to sell when I can get the most premium and when it has the least amount of time for the option buyer to actually make money. Because if we look at theta, this theta is huge relative to the size of this option. 20%, I mean, it's only 5 days away. It has to all come out. So 20% of this option is getting sucked out of this option price every single day. That's what I want. I want to sell you this, and I want the price to just plummet as soon as possible, and this expires worthless on your ass, and then I just keep your money. Now, granted, if the price goes up above 19.5, okay, I make $100 here, and then if it goes up to 25, then you get to celebrate and you get to tap dance on my grave. That's fine either way. We both made money, and that doesn't really bother me a bit. But if I'm a seller and I'm attracted to anything under 45 days, then it makes sense that if I can make less and less and less and less and less money every week I go out, then that means you're going to have to pay less and less and less and less per strike, per the strike price. So unless you have a strategy that is like in and out, a lot of momentum traders will buy an option and just day trade it, and they're out of it the same day, so they're only going to lose, some portion of this 10 cents here. And if you have, I don't know how they didn't necessarily do it, but if you have some kind of information and you're riding a wave and there's something that's just pumping or whatever, and you can get in and get out, more power to you. I don't fuck around with that stuff. But so if I want anything under 45 days, then it makes sense that the option buyer wants something greater than 45 days. You want to go out as far as you can and still be able to afford it. And so that brings me back to Tesla a little bit. And so when you buy a share of stock, the Greeks really don't apply. So one share, you control it fully. So one share is one delta when you own it. But these options only give you like partial control of the shares that you're buying. And so delta is kind of like, it represents the amount that this price of this option will change based on $1 of the stock moving. So when you own the stock and the stock goes from $100 to $101, your stock goes up $1 because delta is 1. But in options, this $60 option, if the price of Tesla goes up from $182.78 to $183.78, the price of this option is not going to go up $1. It's only going to go up 69 cents. So it'll go up to whatever, just over $61. Now, the calculations I'm going to do here is, let me make this reasonably small and still be visible, maybe. All right, so a decent metric to look at, oh, I covered up the frickin' price of the, there we go. So you want to control as much price as possible, and you want to pay as little for it as possible. So I'm going to go just out of the money so that there's no intrinsic value in these calculations. This is all extrinsic value. And so if we take 60.33 and divide it by the delta that you can get for it, this is basically $87 per delta. All right, let's go up to 300. 31, 33, whoops. 31, 33 divided by 0.4457. I screwed this up, right? Yeah, I sure did. 33 divided by 0.4457. All right, so the price went at the money, or actually just out of the money, was $87 per delta, but if you come up to the 300 strike, it's only $70 per delta. And if we come way the hell up here, why did I go to the 480? And so here's the other thing too, is you can only go up so high on different expiration dates. But in the nosebleed section up here, 1388 divided by 0.2348. Delta here. So the price is only $59 per delta up here. So that could mean that if you want to get the most delta for your money, you're going to buy these deep out of the money options. Now, and here's the other thing too. What this means is when you buy a call here, it means you are buying the right, but not the obligation, to pay $480 per share for Tesla at some point before this expiration date, and this is like 2 years from now. So if you think at some point, well, okay, so technically if you think that Tesla will be over 480 by this date, then you would potentially think this was a good thing to buy. And but that's not even the point. So you have the right but not the obligation to exercise this call and call away the shares from the other guy and pay $480 for them, which you would do, which would make sense if the price was $481 or higher. Really, if you pay $1,300, this needs to go to $493. That's why the break even is $493.88. However, so yeah, let's just say that the price went to $550. No brainer. You'd make $70 a share. However, but the point of buying options isn't so that you can actually do that. That will almost never be advantageous. And the reason is because any stock that's in the money has some intrinsic and extrinsic value. And if you exercise it, you're only going to get the intrinsic value. You're not going to get any of the value from whatever time is remaining. So the point of buying an option is just so you can sell it. It's 99% of the time not to exercise it. Exercising is almost never going to make any sense. The only thing would be is if like there was no open interest, there's like no bids here, and you want to sell this for a profit, but there's just no way to do it without getting screwed, and you just can't close this contract. That is one reason why it would make sense. I'm not familiar with any other reasons, but there could be a bunch of them. But in general, even doing that, you are definitely losing some value based on time. So this theta right here is how much of the value of this option is draining out every day. And however much of this that's left, this number times the number of days left is how much money you're leaving on the table if you exercise an option. So, however, if I'm going to buy options and I'm actually considering buying some of these deep out of the money calls in Tesla because options are, the premium is a little bit cheaper in Tesla than it is MicroStrategy right now because of the volatility with Bitcoin. So I may start stacking some of these deep out of the money calls in MicroStrategy, but they're a little bit too freaking cost prohibitive. And but this one in particular, you can go all the way up to almost $500 a share. And so every week, maybe I'll just pick up one of these and I'll just start dollar cost averaging into it. As a holder, I would never hold on to this option if it got under 60 days. I would really look to start selling it at 90 days and take whatever profit I can and then just roll out to, 2 years later again if I still believe in the stock or whatever. Yeah, that's mostly what I wanted to talk about here. For an option seller, you want short expiration dates. You want there not to be a lot of time remaining so that there's very little time for the option buyer to actually make any money. It really has to, the stock really has to move quickly upward for them to profit. And so the reverse of that, if I'm an option seller and I like close, short expirations, it only just makes sense that the buyer would want to go out here as far as possible. And then the opposite of that too is that to be selling calls out here is disgusting. If you're trying to sell this call way out here, you're going to make 3 cents a day, and you're going to have to pay, if you're selling covered calls, that is, you're going to have to pay $18,000 for 100 shares just to make 3 cents a day. Like, that doesn't make any damn sense. So it makes sense for the buyer because he can buy this and only lose 3 cents a day. But it doesn't make any damn sense for the seller to come out here and sell a put. You know, selling at the money put. Oh yeah, look, I got paid all this premium. Yeah, well, how much do I get to keep? I get to keep 2 cents a friggin' day. That means I'd have to wait 50 days to collect $1. All right, not financial advice, but I would never sell any options out past 45 to 60 days. But I am absolutely going to start looking at maybe taking some of the covered call premium that I have been collecting and just start dollar cost averaging into some of these deep out of the money. Some of these mining stocks are sickeningly cheap. You can look up to 50 there. 50 there. Yeah, I mean, January 2025. No, that's not long enough. I want anything related to Bitcoin. I want like end of 2025, beginning of 2026. So let me just look at MSTR. Going from one extreme to the other. But let me just, if you go out here to June 2026, and even if you go to the top of this is $27,000. But let's just run the same thought experiment. So just out of the money. That's my calculator. So this is 626 bucks. Here's the other thing too, though, that sucks about MicroStrategy. Maybe one day if they like do a stock split or something, and I don't know if there's more shares traded, the liquidity will get a little better. But the bid-ask spread on this is 20 bucks. Now it's way the hell out here, so you can kind of excuse it. But liquidity is very important in any trading, but particularly options trading. So this is, oh God, this is $821 per delta. Oh God. All right, so let's look at 277, the very tippy top of this options tree, divided by 0.4351. Okay, only $636 per delta. Now, so you can get way more, deltas in Tesla than MicroStrategy, but MicroStrategy is over six times the price. So if you took this 60 bucks and took it like 6 or 7, that's like 360, 420. Even making the share price equal, Tesla is a way better deal as far as if you're just trying to buy deltas. But if you are determined to buy a Leaps a MicroStrategy Leaps, and I may start doing that too. So here, what I normally do is I buy shares with the premium. But as I just discussed before, the delta on share is 1. So if I want to control 100 shares of MicroStrategy, I got to come out of my pocket $128,600. But if I want to control 100 here, it's like, what is it, 500? Yeah, 600. So you can Well, and here's the other thing too. If MicroStrategy does pump to 2,000, 3,000, 4,000, 5,000, this delta is going to change. So you're buying it at, at this price, you're buying a 4.43 delta. But once this becomes in the money, if MicroStrategy is 3,800 around expiration, now the delta is closer to 0.76. Or if it goes, deep in the money, delta is going to get higher. So by buying it now, you can get the cheaper price per delta. And then if you do get a pump, now the delta is getting bigger, so the price of your option is growing more per dollar than it was before the pump. So the pump benefits an option buyer in two ways. Obviously, getting the 43 cents per dollar is one thing, but then delta actually grows per dollar. I believe that's gamma. Yeah. Yeah, I hope I'm not screwing that up. Yeah, gamma. So for every dollar that the price moves, delta is actually going to go up 0.2, 0.3. And then gamma also can change based on the dollar amount. So, and at the time, the days to expiration. So gamma is going to get huge close to expiration. So it was 0.0002 before, and now it's 10x what it was back then. And then at like 0 days expiration, gamma risk is huge, and basically at 0 days to expiration, close to 4 o'clock, the price of the option is going to move dollar for dollar with the price of the stock. So I'm definitely going to take a look at how much deep out of the money calls I can afford. I probably won't be able to go this far with MicroStrategy. I mean, the longer the better. Like a year is what people usually target, at least for leaps. But man, that's brutal. Going out and shelling out 11 grand, and that's not even a year out, February 2025. But again, that's why I'm kind of looking at Tesla. I think Tesla's pretty undervalued right now as well. Not many people are really buying into the idea that it's an AI company, even though they got friggin' robots in the factory. They're training to do factory work. I don't know how many other car companies have robots walking around their factories, but I can't think of any. And any that eventually do will probably be licensing the software from Tesla, because they're going to stick FSD in their robots. Yeah, but this is much more affordable. Tesla, I think I actually have some much shorter expiration options, maybe October, something like that. Yeah, I may just start dollar cost averaging into some of these just deep out of the money leaps, and then just watch them, and then if well, yeah, I got a little off track. So instead of buying individual shares of MicroStrategy, if I'm buying deep out of the money leaps, then I can get more. If the price does pump, I can get more bang for my buck. Let me see if I can afford any of this crap. November, October is almost 6 months. I mean, that's still kind of pushing it. Yeah, we still got to pay $6 grand for this. Let me go November. 3,800 strike. Yeah, 7 grand. So that'll be tough to do. I think I'm probably making around 3,000 to 4,000 a week on premium. So I would have to save up 2 weeks of premium here just to get one of these deep out of the money calls, and that's not even 6 months away. So I would only be able to hold onto this for about 70 days before theta would get out of control. So that's way the hell longer than I intended to talk today, but I hope it was helpful. All right, be good, y'all.